Let's get in our guest to resume this discussion. We've got with us Abhijit Chakrabarti, Senior Vice President Institutional Equities at Fortune Financial Services, who now joins in on the show. Abhijit, to start off with, do you concur with these expectations of a 2.6% December IIP? And how much would you attribute to this in terms of, its importance to these kind of numbers?
Yeah, good morning to you. Yes, I also do feel that the December IIP numbers is going to be more flattish growth on a YOY basis. One of the reasons is because we are continuing to see slowdown or say lack of pickup in the activity in the mining space and in certain sectors in the manufacturing space. That is one reason, but compared to November where we saw close to 6% IIP growth, December is going to be muted and flattish primarily because of the base effect of December last year, which have seen a very sharp rise. So I think even if we see 1 to 1.5% and if a 2.6% kind of a figure comes, I think it will be very positive because the base has gone up substantially. Even between 1.5 to 2.5% kind of a growth rate for IIP for December, I think it will be taken positively by the market. And coming back to your question of whether how much relevance these numbers carry, I think, these numbers do come with a lag. I mean, December numbers getting reported in the first week of February. And people who are in touch with the markets and industry on a regular basis are aware of the fact that there is a slowdown happening in particular sectors. So to that extent, it doesn't come as a very big surprise, but these are reference points. Having said that, I don't think that, market is going to react negatively to today's IIP numbers, because going forward the expectation is that we are going to see some kind of a pickup in manufacturing sector, mainly from steel and cement, which are seeing increasing uptick in volumes. And even mining, we are expecting some kind of a positives to come up after the Karnataka resolution happens from Supreme Court. So there could be better times ahead, and even with a muted flattish IIP growth, market should hold on positive.
Right now, Abhijit, based on your engagement with corporates, the sense is the sense you get one of that being the performance from January onwards is going to actually be significantly better than the numbers that we are seeing come out for November, December. Do you expect that IIP will actually perk up very strongly in the last quarter of the current financial year?
No, that is not what our estimate is. I think between April to November, IIP growth for the year till date is about 3.5%. And though we expect some kind of an improvement in the fourth quarter, but we are going to end the year with around 4 to 4.5% kind of an IIP, which means that there's going to be an improvement in the fourth quarter. But there is not going to be any dramatic improvement anywhere. We are going to see perhaps a sustained kind of an increase in electricity, which has been continuing. Mining can see, because it has fallen so much and there's a lot of issues regarding the ban in Goa and Karnataka, if there is some kind of a resolution which happens by then perhaps we can see some kind of an improvement in the February-March data when they get released subsequently. But otherwise, the capital goods is one sector which has been having problems, and on the ground there is nothing significantly that has changed in terms of order inflows for capital goods or the other large infra space. But certain sectors could start doing well, like cement, where the volume pickup is strong. I think even the passenger car segment could starting to do well. Steel volumes are likely to go up. So the manufacturing, certain pockets are likely to start improving. But again, given the fact that there will be other sectors like mining and electricity, which will be perhaps having a sustained kind of a muted growth, and also the base effect of last year, will ensure that we are going to have maybe a slight improvement in the fourth quarter. But overall for the year, we are still going to trend at about 4.5% kind of an IIP growth.
All right, Abhijit, we'll come back to you in just a moment. Stay with us. But of course, given the weak IIP numbers that we are getting, that we have been seeing month on month, the big concern is whether indeed we will be able to touch the 7% mark as the government believes we will. The broad view within industry and the markets is that we may not even get to 7%. But let's bring on to the show Arnab Das of Rubini Global Economics. He joins us on the show from London. Arnab, to begin with, what would your views on the projected sub 7% growth and the correction in inflation be? Is it as per expectation?
Well, I think it's it's becoming the consensus, and we certainly share that. We're actually quite concerned that the world economy, including India, which is an increasingly obviously important part of the world economy and increasingly integrated into it, will slow down quite significantly. We expect the world as a whole to grow sub 3% this year, partly because of the crisis in Europe, partly because we expect the U.S. deceleration to be, or the U.S. recovery to be quite anemic still, with 1.7% growth this year. And similarly, we expect India to let's say, continue to underperform potential, as many countries in the world will have below-trend growth this year. Despite the optimism that's taking place right now, that optimism, I think, is justified in some respects in various risky asset classes, and the rally probably has room to run, particularly if the upcoming end-of-month LTRO tender in Europe is a very large one, because it will help further stave off and firewall the event risks in Europe against the banks and the event risks, let's say, in Greece against other countries, and that will have a positive effect around the world.
Arnab, do you see a pickup in the investment cycle going forward, and when do you believe it will happen in India?
I think there's every reason for the investment rate in a secular sense to keep rising in India. Obviously the infrastructure bottlenecks and needs are well known and often talked about. I think the question is about having the right global and local macro environment and the right business operating and financial conditions. Obviously, none of those things is ever going to be ideal, but perhaps once interest rates have started to be eased more aggressively and people see something of a bottoming in this cycle, we'll see a bit more of a pickup in investment in general and infrastructure in particular. I think the private sector obviously is going to have to do more of the heavy lifting there, given the fiscal constraints that the central government faces.
Arnab, I'm going to come back to you in just a minute, but Abhijit, bringing you back in, the same question put forward to Arnab, the question about the investment cycle, which we've seen, it's pretty much broken down. How soon do you expect it will actually begin to turn?
See, as far as the investment cycle is concerned, it will be dependent upon a couple of other economic factors. One is how the government is going to address the fiscal deficit situation and the concurrent tax implications which can be coming out of the budget. That can have an impact. And secondly, what we have seen is the private investment has been slowing down because of the lack of capital and also the fall of demand in the general economy. So if the government is going to address these two things, and also I feel that there is a growing optimism that the interest rate cycle is going to come down quite sharply, which may not materialize to the extent that is being anticipated, because fiscal deficit situation continues to be very high, and there are pressure points within the inflation, like oil, which is artificially being kept down because the price increase is not happening, and the protein-based food items, which are continuing to be a sticky issue as far as inflation is concerned. So if the inflation continues to be a little more sticky than anticipated, interest rates may come down by not more than 100 basis points during the course of the year. And 100 basis points correction in interest rates is definitely going to be taken positively by the corporate sector. But overall investment scenario, I don't think it's going to materially change, because there has to be an underlying pickup in demand, and the interest rates have to substantially come down for the new projects to become viable. So maybe in the next 1 or 2 quarters we are not going to see pickup, but having said that, yes, from where we are today, I think things are definitely going to improve in the coming few quarters.
Sure. Hold that thought, Abhijit. Arnab, just to take it back to you, you did mention that India is not near the end of the rate cycle. Why do you believe so? Because we've seen a CRR cut, now we're seeing a pause in interest rates. If you could just explain your view, because do you believe there is still a case of a rate hike, and what's the probability outcome of the same?
No, actually, we've changed that view, because so we did actually start to call for, we did call in the end for a cut in the cash reserve requirement and a temporary pause in the rate cycle, and now we're expecting several rate cuts from the RBI. Really, when I made those points, I think it was before the full onslaught of the credit crunch or the credit interruption even from Western Europe, and its impact on emerging markets, which, as I said before, have really been quite impressive in their effects on many emerging market countries, including and especially India. And this is why we are not so bullish on the Indian currency. I think that emerging currencies in general have rallied already quite strongly to a large degree in response to this ECB LTRO and the general return of risk appetite. Currencies have rallied more than the underlying assets in many cases. And certainly in the case of India, we're quite concerned about the external financing issues, the twin deficit issues, the lack of room for fiscal maneuver, which probably means there'll be more take up on the monetary side of dealing with the global and local slowdown. So we're expecting a series of rate cuts now into 2013 in the expectation that inflation with growth will tail off. And therefore the currency will tend to underperform.